My net is disconnected. Let me continue. The question I wanted to solve. Let me share my screen. Question. Following are the summarized accounts of India, New, and Delhi for the year ended 30th June 2018. So you have the financial position made for the three. You have the income statements for the three. And then you have additional information. Indian acquired 60,000 shares in New for 3 years. 3 years ago, when the accumulated profit is 15,000. At the date of acquisition, the fair value of New's non-current assets, which at the time had a remaining useful life of 10 years, exceeded their book value of 5,000. The group policy is to calculate the goodwill arising on consolidation of a subsidiary gross with the non-controlling interest at fair value. Then we also told that at appreciating the fair value of the non-controlling interest was 24,000. That's for New. Then we also told that as a result of the appreciation of New, there was no impairment loss during the impairment review. So impairment review reveals that no impairment loss has arisen. India acquired 120,000 shares in Delhi 3 years ago when the accumulated profit was 5,000. At the date of acquisition, the fair value of Delhi's non-current assets, which at that time had remaining useful life of 4 years, exceeded the book value by 20,000. The impairment review reveals the recoverable amount of Delhi at their year end to be 103,333. So the additional information has been structured well. It has not been mixed up. So for additional information 1, from additional information 1, additional information 4 relates to New. So everything from information 1 to information 4 relates to New. Everything from information 5, 7 relates to Delhi. Okay, so when you are doing the adjustment between India and New, you look at additional information 1 to 4. When you are doing any adjustment between India and Delhi, you look at additional information 5 to additional information 7. That's basically what it is. The very first thing you have to do is to calculate your group structure or your percentage holding, which some may call it. Okay. So group structure simply means how many percentage of New is Delhi controlling and how many percentage of Delhi is did I say of New controlling? How many percentage of New is India controlling and how many percentage of Delhi is India controlling? We're told that India acquired 60,000 shares in New. And when you go to the balance sheet, the shares per price or the price per share is 1 Ghana cedi. And to that extent, New will have 75,000 shares. Delhi will have 40,000 shares. So if you buy 60,000 of the 75,000, then it means that 60,000 of the 75,000 multiplied by 100 will give you 8%. What it means is that India is controlling 8% of the net assets of NEO. When he came here, he acquired 12,000 of the 40,000 in Delhi, which gives him 30%. What it means is that India is controlling 30% of Delhi's net assets. So whatever profit or losses are declared by the two entities, India is entitled to 80% of NEO's profit or loss. India is entitled to 30% of Delhi's profit or loss. In group accounting, when you control more than 50% of the net assets, you become the parent company. And to that extent, once you are a parent company, you hold the majority share. You have the majority. And so therefore, you have the power to control the financial and operating policies of that company. So by extension, India controls 80% of NEO's net current assets. So therefore, India has the power to control all the financial and operating policies of NEO's net assets. And so therefore, whatever decision is taken in NEO's company, India has the majority say. India decides how the company is run. Whatever decision is taken, India has the final say. The others who have the 20%, they are in the minority. So basically, the majority will have their way, the minority will have their say. So the 20% will say whatever they want to say, and the majority will keep calm and they'll have their way. Just like NDC, NPP, NPP is the majority, NDC in minority. NDC will make the noise and jump on rooftops and everything. At the end of the day, NPP will say e-levy, we go bring them. They will bring their e-levy upon all the shouts. When you go to the next one, acquisition in Delhi by India gives India 30% control. You can see that in this aspect, India has 30%. India does not have more than 50%. So India cannot control Delhi. So the relationship here does not give India the chance to become the parent company. Unlike the first one. It's a parent-subsidiary relationship. And so therefore, you can control the accounts or you can consolidate the accounts by merging the two accounts. Here, the relationship here is called an associate. Delhi is an associate to India. And so therefore, India relationship there or India right over there is to sit down. He cannot consolidate or add the two accounts. Wait, when Delhi declares profits, then he say, Delhi, the profit you have declared, please give me my 30%. You take his 30%. The loss you have declared, please give me my 30%. You take his 30%. So India is just waiting for profit and losses to be declared. Then he gets his share. Then that's it. So India will just add 30% of Delhi's proportion net assets to his account. That is what it means. So India is going to use what we call equity accounting to consolidate Delhi's account into his account. That is basically what it means. But in the first instance, India will use the full consolidation method to consolidate NEO's account into his account. The next thing you do is determine the net asset of these two companies. Because before you acquire a company, before you take over a company, you must know the position of the company. By so doing, a new balance sheet has to be prepared. or the balance sheet, existing balance sheet has to be reviewed. Existing assets and liabilities has to be revalued, and know that this is the position of the company I'm taking, and you are clear in your minds whatever you are taking. At the date of acquisition, stated capital for new 75,000. When you look into the question, you see it. At the date of reporting, new has not float new shares or have not sell new shares to the public, and to that effect, the stated capital remains 75,000. We're being told that at the date of acquisition, income surplus of new is 15,000. You go to the additional information one, you see it. Income surplus is 15,000. And at the date of reporting, news income surplus is 51,000. So date of acquisition 15, date of reporting 51,000. Then same again in additional information too, we're saying that the non-current assets, when they are valued, they exceeded their value by 5,000. It's more like a revaluation gain. Okay? So at the date of acquisition, there was a revaluation gain or a fair value adjustment of 5,000. And still it remains like that at the end of the year. Guess what? It is asset that has gained value. So depreciation must be carried on, or depreciation must be calculated at the end of every year. Now, at the date of acquisition, we were told that after the time they were doing this revaluation, the particular asset they were revaluing have 10 years more. They have 10 years more. What they are trying to tell you is at the date they are buying, at the date India is buying new, news net asset has 10 years more to live, or 10 years more to exist. And this acquisition they are talking about happened 3 years ago. It's like a 3-1 over here. The acquisition happened 3 years ago. No, we are in 2018. If we are in 2018 and they said acquisition happened 3 years ago, it means that it happened in 2015. We are in 2018 and we are talking about something that happened in 2015. Take note. Means that this thing happened in 2015. So if you are complete depreciating, if in 2015 the thing is 5,000 and it has a useful life of 10 years, the 5,000 divided by give you 500. So in 2015 it has 500, 2016 it has 500, 2017 it has 500. So for the past 3 years, how much depreciation have we done so far? I have 1,500. Then I put it. And I add all this one. The total I get is 129,500. When I add all this one, the total I get is 95,000. I do the same thing for Delhi. The same thing I did just now for new. I do the same thing for Delhi. So when you go here, additional information 4, additional information 5, India acquire 120,000 shares, the same blah 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 blah. It's like the same wedding. So additional information 6. Forget about additional information 7 for now. So I would like you to do the same thing. Go and look for the stated capital in the accounts. Go and look for the accumulated profit at the beginning. It is in the footnote. And accumulated profit at the end. Then the book value that was adjusted. That was there. How many years? Divide. I think it is 4 years. Divide, you get 5,000 per year. You can see why I have 555. Make it 15,000. I just wanted to go to see how best if you can understand this particular slide that we did for this one. Then you are good to go. Now, when you are done, the difference between your acquisition date balance and your reporting date balance is called your post-acquisition surplus. So the difference between the reporting date balance here and the acquisition date balance here is the post-acquisition surplus. What remains is that you said before you acquire the company, they themselves have profit of how much? 15,000. They also have assets of so and so amount, which as a result of your acquisition, they have gained additional how much? 5,000. This is what is there. Now, after the acquisition, or from the day you acquired to the day they are reporting, the profit now stands at 51,000, meaning there has been an increase, right? Good. This one stands at 5,000. There was no depreciation at the beginning, but at the end there was depreciation. So what was your performance? What was your addition? If at the date you are acquiring, the total net asset is 95,000. Now, when you acquire them, you help them to increase their net asset to 129,500. How much have you added? You have added 34,500. As a result of that, the company has gained 34,000 more. As a result of the acquisition, the company has gained 9,000 more. So that is the post acquisition. So it means that 80% of this yours, 30% of this yours. That is basically what means, or that is basically what means. So the next thing you have to do now is to zoom straight away into your workings. Now, you have been told that so the wisest thing to do is to do the equity accounting first. Know the proportion of profits and losses you have from Delhi, and then incorporate it into your account as a parent. So we are going to do all workings between India and Delhi before we go and do working between India and NEO. Now, when you are reading from India and Delhi, note 7, they say impairment reviews are the recoverable amount is blah, 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 blah. So if we are saying that recoverable amount simply means that if today we are selling a business, this is how much you are selling, we sell the business for. Okay. So you must know the worth of the business at the date of reporting and know really if what we are buying is correct. So we are investing 30,000 in the business. That is when it goes to balance sheet, investment in Delhi is 30,000. Good. We are investing 30,000 in Delhi. And from your calculation, Delhi put acquisition surplus is 9,000. So after you've invested, you make 9,000, and 30% of that is 2,700. So in total, what you will make at the end of the year is 32,700. This same business can be sold for 103,333. And in this 103,333, when you calculate your 30%, you are entitled to 31%. So if at the end of the year you are going to make 32,700, and this business when sold you are going to make 31,000, then it means that there's a problem somewhere. The carrying value is greater than the recoverable amount, meaning the book value or the value of the business in the books is greater than the value you get from the markets. So there is an impairment loss of how much? 1,700. You must take note of that. Then you also go and look out for the investments in the associate. When it comes to associate accounting, we say we do what you call equity accounting. Sorry, my network disconnected. So what I was saying is that when it comes to equity accounting, you needed to know the investment in associates. Okay, you needed to know the investment you made in associates. And the investment, you calculate the investment by adding our cost of investment, our profit, less any other impairment losses. So you've made investment of 30,000. The profit you will be making is 2,700. Impairment losses this So it means that the cost of investment that will appear on your balance sheet for the associate 31,000. Then we move on to look out for goodwill when you go to the. Now we are going to do all working between in India and new. India and new. The very first thing they spoke about is goodwill. They said the group policy is to calculate the goodwill arising on consolidation of a subsidiary gross, with NCI at fair value. At acquisition, the fair value of the NCI was 24,000. So what basically they are trying to tell you here is that as a result of that acquisition, the book value, there is a goodwill. Okay, there is a goodwill. That is basically what we are being told over here. So in a nutshell, what does it mean? The price you pay for the business is 92,000, and the fair value of net assets or the proportion of what you are getting 24,000, or that is basically what we are talking about. But the cost, sorry, the what word will I explain this particular one for you right now? Let me take this to the net asset. Okay, the net asset at the acquisition was 95,000. So from your calculation, this is the total value of the business you should be having 116,000, but the net asset valuation is giving you 95,000. So what it basically means is that you paid something more, okay, than the value, or what you are committed to is more than the value of the business. So you have paid 21,000 more, or yes, there is 21,000 more